Welcome back to another episode of our journey through economics. So, like the previous two episodes, we will try our best to break down the knowledge we have acquired as simply as possible and present it in a way that actually makes sense for real people.
Today is a big one. We're now on chapter 3 of The Intelligent Investor. It's the densest chapter so far, probably, but honestly, one of the subtle key ideas in the entire book. And we're going to tie it together with chapters 1 and 2, because chapter 3 is basically Graham's backing them with a century of history.
Before we dive into chapter 3, let's zoom out a little. No point viewing each piece of the puzzle if we don't occasionally get a more holistic checkup. So, chapter 1 introduced the differences between speculators and investors, or defensive investors and the more ambitious ones as well. That framework is what to bear in mind if you wish to continue reading.
Right. And Graham's whole point there is that the strategy has to be suitable to your temperament. How much effort you're willing to put in, how much volatility you are ready to accept, and how disciplined you can be.
Then chapter 2 then talks about the relationship between the investor and inflation and how inflation strips away your purchasing power. Graham reminds us that it's not enough to make nominal gains, you need gains that outpace inflation. Markets can be duplicitous. You can feel like you're winning, but in real terms you might not be.
So, chapters 1 and 2 are setting up these mental frameworks. Who are you as an investor? What's the real value of your returns? What forces muddy the water and make you think otherwise?
Exactly, and chapter 3 takes that theoretical foundation and supports it with real life examples to show how his claims step up to the plate in practice.
Chapter 3 is essentially Graham making history his fossil. He steps back from individual companies or economic forecasts and looks at long decades of data.
And the big insight is that the stock market has recurring patterns. The bigger insight is that investors continue to fail when it comes to spotting them.
He wants readers to build an intuition for recognizing when market prices are likely to be responsible or optimistic. And he's reminding us the defensive and enterprising investor both need this context, just in different ways.
One of the most interesting things in chapter 3 is how Graham uses historical valuation ranges like price to earning ratios over many decades to show how often markets fluctuate between being underpriced and overpriced.
He's not saying people are idiots or not intelligent. He's saying people do the same emotional things in every era because uncertainty is an uncomfortable fact of life.
And it loops back to chapter 1's focus on temperament. Defensive investors need this historical context to avoid overpaying for stocks just because everyone else seems confident. Enterprising investors need it because they're making sure to evaluate the opportunities, and without these artifacts of history to look back on, they risk drifting into speculation.
The inflation perspective of chapter 2 also contributes a bit here to these overall dynamics. Sometimes stocks appear at first glance to be either expensive or cheap depending on the economic environment, including inflation rates. Graham isn't fixated on exact thresholds. He wants readers to understand relative valuation, relative to history, earnings, and bonds.
One of Graham's crucial comparisons is earnings yield versus bond yields. He doesn't want investors just looking at stocks, end the search there, and sit contentedly.
Yeah, he's saying picture the investor's dollar as a free agent. Stocks and bonds are both a part of its domain. Whichever asset has the most attractive return and safety will steal away that dollar.
So I see chapter 1 making its mark again. The defensive investor likes leaning toward balanced stocks and bonds together. Understanding this relationship shown in the years since these things were first recorded is vital in maintaining balance.
And for the enterprising investor, this relationship is one of the few legitimate macro signals to really focus in on.
Graham has this quiet frustration throughout the chapter. Investors forget history incredibly fast. Every generation believes the market is different now. It's easy to see why one may think this. Technology evolves, products change, global events from uprisings to downfalls. They shift things around, but human behavior is one convenient and inconvenient, constant. Valuation mistakes don't change, overconfidence doesn't change.
And that's why chapter 3 sits so perfectly after chapter 2. Inflation complicates things, the economic backdrop changes, but behaviors remain the same. And Graham wants us to see that through the lens of a century's worth of data.
If we had to distill Chapter 3 into one core lesson, it's this. Vast expanses of market data throughout the ages enforces emotional discipline more than predictive power.
Graham isn't telling us to use history to forecast the next 5 years. He's telling us to use history to avoid being swept up in the current narrative.
That down-to-earth idea was already hinted at in Chapter 1, discipline identity as an investor, and reinforced in Chapter 2, don't let inflation or nominal numbers trick you.
And in Chapter 3, he gives the data backbone for all of it. A century of prices, earnings, and mood swings. This chapter holds weight in the present still. Valuations don't matter anymore, is a growing sentiment I feel.
As for Graham, he's not saying markets crash immediately when valuations stretch, he's saying stretch valuations lower future returns.
And he's not anti-stock, he's anti-irrationality.
Exactly. Chapter 3 is Graham's antidote to the belief that short-term comfort equals long-term safety.
This was another good chapter to talk through. It was not super out there and trying to stand out, but it's yet another groundwork. It gives you the prerequisite knowledge to apply every idea that comes later.
Absolutely. If you master chapters 1, 2, and 3, the rest of the book becomes far more intuitive. Next episode, we'll jump into chapter 4, where Graham starts laying out practical portfolio guidance.